Thank you, Vanessa. Good morning, ladies and gentlemen. As the title suggests, these are bleak times for commodity markets and difficult ones for mining companies. But in this short presentation, I want to try and lighten the gloom and consider this phase of the cycle as a time of opportunity. I'm going to start with a question. If we don't know where we are going, do we know where we are? Now, we can all make well-informed, well-educated predictions about the future, but the fact is that nobody knows what will happen tomorrow. By the way, if anyone does know what's going to happen tomorrow, please see me afterwards, please. So let's deal with the simple question, do we know where we are? To answer this question, I've compared the third quarter 2015 average prices for 5 metals with CRU estimates of long-run marginal costs. Now, in CRU, we use long-run marginal cost to drive our long-run price forecasts. Notice that the metal prices are way below their estimated long-run marginal costs by 20 to 30% in the case of aluminium, iron ore and zinc, by just under 20% in the case of copper, by a massive 45% in the case of nickel. Does such a large gap between current prices and the long-run guidance imply that we are near the bottom of the price cycle? And how does this compare with previous price cycles? Well, history suggests we must be close to the bottom, even if the timing of the turning point is uncertain. These charts depict historical prices since 1970 as a percentage deviation from a fitted trend line. Taking aluminium, for example, in the top right, at the bottom of previous cycles, prices hit a low point of 20–25% below trend, fairly reliably so. The same is broadly true for copper and zinc, while for nickel, prices have dropped as low as 50% below trend at the trough of the price cycle. Now, if we recall the previous slide, we see that if the long-run marginal cost is the future trend around which prices will fluctuate, aluminium, nickel, and zinc are already in the region where historically they have hit the low point in the cycle. Although, as Vanessa said, copper may still have a little way to go. So in general, although we cannot predict the precise turning point, and prices can bump along the bottom for several months, or even quarters, or even years, as some pessimists have pointed out to me, we feel that the bottom must be close. So, the only way is up. I see some doubtful faces. The only way is up, or is it? Well, that depends on whether the long-run marginal cost is a good guide to the long-run price. Vanessa has amply demonstrated, I think, that the operating cost curve and any percentile on the operating cost curve is a moving target, and prices often drive cost as much as vice versa. In this industry, investments have long lead times and 30 to 40-year lives. We need something more stable to guide long-term decisions. In CRU, we use long-run marginal cost to anchor our analysis, but it is a methodology that must be used with care. The path of reversion to the long-run price will be fast or slow, steep or shallow, depending on the factors shown in the chart here. These factors are, from left to right, the initial conditions, such as the inventory, the excess capacity, the current surplus in the market, the capacity required, which is determined by demand growth, depletion rate, and the share of secondary, and the cost drivers, the input prices, productivity, and the cost of capital, because we're dealing with very capital-intensive industries. To take an extreme case, if there is a large excess of capacity, very little demand growth, and very little depletion, then the path to the long-run marginal cost will be long and slow. So what I'm trying to say is it's when people use long-run marginal costs, sometimes they're called incentive prices, they need to be used very intelligently. It isn't just a case of, oh, we have a project, here's our long-run copper price, stick that in, let's see what the IRR is. That's not the way to do it. In particular, in this cycle, recovery depends on the adequate supply response. And with China accounting for 50% of world production of some metals, that supply response needs to come from China. And that is one of the big unknowns and big worries of this cycle, and which is why one might say, well, it's always happened in the past, but this cycle is different. Personally, I think the rest of the world has reached a tipping point in terms of its willingness to accommodate China's surplus production, for example, of steel and aluminium. The influence of China is another reason why we must discriminate between commodities in terms of the path of price reversion. In terms of recovery, there's no one-size-fits-all. Let's look at some of the initial conditions in the various markets to look at when is new capacity needed. Initial conditions can make a big difference to price reversion. The time when new capacity is needed in the market is determined by the level of inventory, the amount of existing excess capacity, and the firm and committed capacity expected to come on stream. For aluminium, we see that the market does not need new capacity for another 8 years. I'm talking about smelting capacity there, which compares to a lead time for building a smelter of 3 years. At the other extreme, a new zinc mine capacity is needed in 2 to 3 years' time, a lead time that only mine projects at a very advanced stage can meet. So the time path of price recovery for those two metals is going to look very, very different. If the long-run marginal cost, used intelligently, is going to anchor our long-term view, it should not change too frequently. Sometimes I see long-run price guidance changing with every change of direction of the wind. However, it should respond to structural change, such as a fundamental change in demand growth. If China slows down much sooner than expected, how does that impact our long-run prices? The first and obvious answer is that slower demand growth will delay the need for new capacity, and it will take longer for prices to revert. The second answer is more complicated and deals with the impact on the long-run marginal cost itself. If we need less capacity in the future, we might expect the long-run marginal cost to fall because we don't need to develop some of the marginal assets. And that is true if we have an upwards sloping supply curve, and that's more likely, as you'll see on the chart at the left, for hard rock mines. Lower demand is likely to mean a lower long-run marginal cost because we need to develop less of the marginal assets. And we're dealing with industries where there is a resource scarcity. But the more downstream you go, the more powerful are the learning curve impacts associated with growth. And so lower growth might actually mean a higher long-run marginal cost. In other words, if you're not building a lot of new capacity, you're not learning, new productivity is not getting embedded in the projects. The bottom line, if we expect China to slow down sooner and faster, then it will have an impact on long-run marginal cost and long-run price guidance. So to recap, if we are near the bottom and prices will mean revert, albeit at different paces, what about the opportunities, the upside that I was talking about? Is this a good time to invest? If we are near the bottom of the cycle, then it clearly is a time of opportunity. With hindsight, in a few years or a few months, we may well see that for commodity prices, equity prices, asset transaction prices, we are shopping in the bargain basement. We probably only will appreciate that in retrospect. So is this a good time to invest? Well, yes and no. We don't expect companies to be making big bets on major projects. Why? Cash is short, companies and banks lack confidence, and building capacity adds to the problem of excess supply. Why make it worse when the recovery hasn't even started? But it's also down to the psychology associated with boom and bust conditions. Companies don't tend to make big bets in these conditions. Just as there is irrational exuberance, you see on the left-hand side there, so we now live in a period of irrational depression. So we don't expect people to build big projects. But it is a good time for investors and companies to be making smaller bets. For example, investors buying futures, buying shares, companies making small acquisitions, debottlenecking, small expansions. And none of these are billion-dollar bets. And I think Paul mentioned right at the start, these bets are being made, deals are being done. And as Grant also said, cash is king. Big bets are usually made in times of irrational exuberance, often ending in tears. Is there any end to the boom and bust and its associated psychology? Can we learn any lessons? Well, I think we can fairly confidently say there will be no end to boom and bust. And if there's one statement I've made this morning that I feel utterly confident of, it's that one. But maybe there are ways to counteract the manic depressive behavior. Here are 4 examples of commonly identified investment biases which have become widely known in recent years. Cognitive and emotional biases, and anyone who's read that excellent book, Thinking Fast and Slow, will recognize some of these. The first 2, myopia and herding, lead to the manic depressive nature of the market. More than ever, we need a sense of perspective and an ability to anchor our long-run views on a detailed understanding of individual commodities. The second 2, confirmation bias, seeking data support a preconceived idea, and optimism bias, overconfidence in your own ability to predict events, suggest the danger of internal groupthink and the need for an outside view, especially on major investment decisions. I certainly can recall more than a few instances of confirmation biases in my career. And the greatest value of an outside view is sometimes simply to say no. So to conclude, I have argued that these gloomy times contain opportunities. Even though the appetite for risk is low, even so, small bets can be made on an upturn. Boom and bust will not go away. Sometimes people behave as if it will, but I don't think it will. At times like this, we need to maintain a sense of perspective and of disciplined long-term thinking. Our view should not be blown around by short-term events, but we must respond if we believe there are genuine structural changes. In the next recovery, there will not be a one-size-fits-all impact on metals. Discrimination is needed based on a detailed understanding of initial conditions, committed plans, and the impact of structural changes, including China's transition to lower growth. And finally, a sizable number of economists have replaced rational economic man with a manic depressive who veers between irrational exuberance and irrational pessimism. How else to explain the febrile markets? It is easier to spot biases in others than in yourself, and this is the value of an outside view. Ladies and gentlemen, thank you for your kind attention.